Good morning. It is Wednesday, August 19th. Here's what's on the agenda. Chip stocks tumble, oil gains for a fourth day, and we get the latest read on UK inflation.
That's just dropping now, Tom. We'll get to that in a minute. We'll get to Carlsberg in a minute. The chip sell-off is certainly a big feature of the landscape out in Asia. You saw it yesterday in the United States. You're getting it in Asia. You're not getting it in Europe. So the Kospi's down by nearly 6%. Eurostock 50 futures, though, barely budging this morning, down only 0.2%. That's the difference in terms of the exposure to the AI narrative. And there's a bid back in the bond market. A small one, but there's a bid back in the bond market. The countdown to the opening trade starts right now.
So yes, a significant drop in terms of the chip equity names yesterday. The SOX, the semiconductor, the Philadelphia Semiconductor Index dropping close to 5% by the close stateside. You had the likes of Nvidia, but also Intel, also the optical makers as well. Is this a question of chip makers facing those higher yields? Is that the challenge? Is it the issuance that we're seeing at the long end? Not just government issuance, but also, of course, the AI company issuance that we've been talking about. The demand continues. The structural demand and drivers for these memory companies continues. We know expectations are high,
sure,
but it seems like there are question marks once again. We've seen this cycle again, but are the dynamics different this time around?
Does the market understand what is happening? How good is the market's line of sight on what this cycle is going to look like? The fact that it is still probably cyclical, that chips are cyclical. How smart is the market at understanding that? Because the world feels extraordinary when it comes to this market at the moment. I think it's really hard to predict. So you've got to expect some volatility.
And I think the struggle is that we don't know why we're selling off. We don't know what stops it, right? So it looked like it was yields yesterday because you had a more concerning rise in yields because term premium was going up. But yields have stabilized today, and Asia is still doing very poorly.
But wasn't yet Asia just a reaction to the sell-off that we saw yesterday in the SOX? The question is now, does the Nasdaq continue that trade? Does it continue to turn, or does it stop with the drop we've seen in the Korean market this morning?
And is it Asia-related in particular because you had SoftBank announce this massive 1 trillion yen bond issuance that weighed on Japanese stocks? And so, does it feed through?
Yeah, and that raised question marks, didn't it, about the health of the balance sheet once again for SoftBank, which of course underscores a lot of the financing for OpenAI. And then we get back to that circular financing risk. Anthropic, interestingly, we were reporting on the fact that the revenue run rate was coming in at around $65 billion US dollars. Some people's take on that wasn't strong enough, that wasn't high enough, and so there's question marks about that. But we also know that as well as the debt issuance, there's the equity issuance, the wall of equity issuance that could be coming down the track from the likes of Anthropic as soon as this year. Maybe OpenAI as well. Still debating within the ecosystem as to when that happens. But there will be equity issuance alongside the bond issuance.
Big capital raise in China today. More of that coming as well. So just again, the challenge is more equity is coming to the market in a market that has got used to equity being taken out by buybacks. We're now cash flow negative on many of these companies. And look at what Alphabet's. We don't often get to talk about kangaroo bonds. Love it. But Alphabet's raising money at 7%, nearly 7% down in Asia.
That's a pretty good
down
yield.
In Australia.
Yeah, and if you think about the idea that credit has been pretty contained, except for the ones that are borrowing massively, 7% pickup seems pretty good relative to equities.
You can get 6 or 7% risk-free versus putting your money to work in equities with the lack of the clear sight that you're talking about. I mean,
is it risk-free? I don't know.
Investment grades.
Yeah.
Alphabet, kangaroo bonds, they're being well received, it seems. But there you go, 7%.
But you've got to pay 7%. For it, and you get this crowding out effect. And again, you get, is the tech trade crowding out the government trade? Is the government trade crowding out the tech trade? And what's the opportunity cost to the rest of the economy in terms of all of this?
And some of these issuances are very, very concentrated, right? It's long duration IG that's something like 40% is tech or AI. So I think that's quite concerning. And you have all these other factors going in terms of geopolitics, what's happening with the oil price. And I think yesterday we had more concern around that feed through to equities. Yes, because oil prices rising feeds into higher yields, but also because you're having refined products questions in terms of gas prices being very up in terms of Europe, but also diesel. And that's a direct feed through into your agricultural products, into your manufacturing, into logistics, that kind of thing. Either you pass that on to consumers or you have margin pressure. And so,
and it goes into everything. And that's the issue. We're going to talk to Carlsberg in a minute. What does their input price story, cost story look like at the moment? We'll talk to Evie Hambro later on the show. He specialises in miners. Miners, it is a huge portion of their business. What the input cost story is going to mean for them going forward. Diesel's a big portion. Electricity is a big story. Sulfuric acid's a big story coming out of the Gulf. That's a factor. All of these things that go into everything that we consume on a daily basis are going up. And we're going to talk about the Bank of England data in just a moment.
If we don't have line of sight on the AI trade, as you were signalling earlier, then we certainly don't have we don't have line of sight on what's happening in terms of Hormuz and Iran. And you're right to rate, this isn't just oil and gas, which is up, by the way, European gas futures up about 130% year to date. It is helium, it is the petrochemicals, it is the fact that supply chain takes time to work through, and inventories are being drawn down, and we don't have clarity yet. The poly market odds, or at least some of the betting market odds, suggesting that you're not going to get the odds of Hormuz opening by July of next year have dwindled. So expectations are shrinking, but we still don't have clarity in terms of what that means across all these different factors as we continue to watch. It seems at least a US administration digging in on this.
Let me read you some numbers. UK CPI is on the screen this morning. Month on month, 0.3. That's up. Now, let me just give you some background before I read some numbers. You've got a reset of the Ofgem price cap, and it is up significantly. This is the price cap on energy for UK consumers. It is being reset significantly higher. This time last year, it went down a lot. This time, we're rising a lot, plus 13%. So that's what you've got to factor into your thinking in terms of what you're watching here. So month on month, we are up to 2.9 from 2.6, in line. The core number is slightly stronger than anticipated. It was expected to drop back down to 2.5, but it's up. It remains at 2.6. Services are down pretty much in line with expectations as well. So what you're seeing here is imported inflation, which is the big story for the UK economy right now. It is different to what you're seeing over in the United States, which feels domestically generated. Here, it is all imported. You've got huge slack in the labour market. You are way to the right domestically from where potential is. Sorry, way to the left. That's the issue here that the Bank of England is facing. Yep.
I was going to say the pound, a little bit of a movement higher, 135, just up 0.1% in terms of a very modest reaction there. And markets continuing to price in about 30 basis points of hikes from the BOE by the end of this year, though the Bloomberg Economics thinks the BOE will stay pat.
OK, let's talk about some of the corporates that we're watching and talking about the input prices story that we are watching as well. Carlsberg out of Denmark with numbers this morning, narrowing its full-year organic operating profit forecast. It's nice to get some certainty in a world that feels so uncertain right now. Aarup-Andersen, the CEO of Carlsberg, joins us now to discuss. Good morning. So you're narrowing your operating profit forecast for the year. Every day on this show, Jakob, we talk about the huge uncertainty that there is out there at the moment. What gives you certainty right now to be able to do this?
Well, first of all, we always navigate in a lot of uncertainty, so it may feel like there's a lot right now, but I think that's it's unfortunate. It's a permanent feature of being a CEO. If you look at right now, 2026, we are basically almost through the big summer season across our key markets, and therefore we have a lot of certainty around the delivery on those key big months for the beverage industry. That gives us a lot of confidence in our ability to deliver on this increased narrowing of the guidance that we've just come with today. If you look at it, Western Europe has had a very solid summer. So has Central and Eastern Europe, and that's a key driver for us, including some of the major growth markets like India and Nepal, etc. So it's a very solid delivery over the summer that gives us confidence. And on the top of that, we're also delivering higher than expected synergies out of the Britvic acquisition. So both of those elements are important.
OK, you bring up Britvic. Jakob, it feels looking at these numbers that the stability almost comes from the soft drink side. Are you now a soft drinks company rather than a hard drinks company, I guess, for a better way of putting it? Is that how we should look at this? How have soft drinks done versus beer?
Yeah, you're spot on that the soft drinks part of the business is doing incredibly well. So we're not a soft drinks business. We are a diversified beverage business, which means the multi-beverage gives us a lot of strength. So you have beer in India doing incredibly well. You have soft drinks in the UK doing incredibly well. And all of those elements means that we can also weather any hit we get somewhere in the portfolio. Today, a third of the business is now soft drinks. And it also, of course, then plays a major role in our performance. And if you look at soft drinks in the first half, it's up 9%. So we have 9% volume growth in soft drinks in the first half, which, of course, is a significant growth rate within our industry. So soft drinks is clearly pulling up our performance, and that was the whole reason why we've done the strategic moves we've been doing.
Jakob, and you mentioned the Britvic integration and the synergies that you're seeing there. Where are you in terms of finalising that integration? Can you give us an update on that progress?
Yeah, so the overall integration in terms of especially the commercial agenda is going incredibly well. We were faster than expected in terms of taking out all the basic synergies, and that's also why we are increasing the synergy realization this year. It means at the end of this year, 80% of the synergies of Britvic will have been realized, and that's actually 80% of the synergy target we raised last year. We raised expectations for synergies. We're delivering 80% of that at the end of this year, which means we'll deliver synergies faster, more synergies, and also faster. It's, I have to say, we brought on a business with highly capable people, strong momentum in the core brands, and it's having a positive impact on the entire business of Carlsberg.
What are the heat waves doing to your business, Jakob? Is it driving demand for beer, or is it raising prices for some of those crops that go into the production of these products?
No, listen, I think it has dual impacts, as you're also saying. Of course, heat waves across many of our geographies will impact our business positively. So when there's better weather, then people will be drinking more. On the other hand, we're also seeing that once temperatures get to a certain level, the consumers actually move towards even tap water if it gets too hot, and therefore there are certain temperature levels where it just gets too hot to drink beer or soft drinks, and therefore it's a double-edged sword. We also saw this summer in France, there were even a ban of selling and drinking alcohol at major festivals at one point during the season. So it's a double-edged sword. On the production side, you're right that some of our commodities, they will be more impacted by this. We are seeing crop seasons becoming more volatile. That's why we're spending a lot of time on securing our supplies on long-term contracts. That's why we're putting a lot of money into helping the agricultural industry develop new, more climate-resistant grains. So it's really, for us as an industry, it's a job we have to do together with the agricultural industry to ensure steady supply of our key commodities.
You say that consumers are changing what they're consuming because of the weather, but is there any change that you can attribute to worries over just the economy more generally and any trends that you see from country to country?
Yeah, so I think what we've seen over the last couple of years, unfortunately, ever since post-COVID and the Ukraine war, we've seen quite a fragile consumer globally. Of course, we can point to pockets of geographies where consumers have not been impacted, but globally, we are seeing a relatively weakish consumer. And of course, what we're seeing right now isn't helping. The Middle East crisis is adding a bit extra pressure across consumers globally, but we are not seeing a significant change in consumption patterns due to the recent volatility out of the Middle East. But we do have globally a consumer that is fragile, and therefore, of course, we feel that the environment has been a bit subdued now for a couple of years. But we navigate that. We make sure that we have the right value options. We make sure we have the right the product assortment and portfolio to cater to that as well. And as you can see from the numbers, we're driving revenue growth across all of our regions. So we seem to be getting that balance right.
Focusing in on China, are you worried about the consumer there? Are the poor, earnings there attributed to weather-related issues primarily?
I think China is a case in point. We've seen a weak consumer now for a couple of years. The consumer remains soft, and at the same time, we've seen a June, which was the end of this reporting period, where the weather was, I have to say, absolutely terrible in many of the key regions. It's impacted the whole industry. Going into July, that weather continued, and therefore China right now is subdued. You see that from the reporting from everyone in the industry. We see that as more of a temporary impact, this weather-related impact. We have a very strong business in China. It's been structurally growing for a decade and has been taking share. We're also the highest margin business in China of all the brewers. So a very strong business, but of course we cannot be immune to these significant weather events we've seen recently. So it's something we'll work through, and thankfully the rest of the portfolio has more than mitigated that if you look at the first half.
Yeah. Jakob, you've, during this conversation, talked about weather volatility, you've talked about input cost volatility, you've talked about how you're trying to mitigate some of those factors, and you began the conversation talking about the fact that this kind of volatility is just normal now. Do you think it stays normal? Are you having to deal? Are you dealing with higher inventories, working capital, to make sure that you can deal with some of this instability that we are seeing? And do you expect it to become a kind of permanent feature of the landscape in terms of the way that you plan for the business?
Yeah, listen, I think I'm a great believer that the uncertainty we've been seeing in recent years is something we just need to embrace and take an offensive perspective on in terms of seeing the opportunities that creates. I think major corporations like us, if we have the agility, because we do have the resources, the capabilities, but if we have the agility as well, we should use this to become even stronger. So we are, as a business, we're very well prepared around this. We've also set up our operating model so we can react very fast in these types of environments. And it doesn't mean that we bring significantly more inventories into the value chain or things like that, but it does mean that we have very fast decision-making processes and we can be very fast on our feet in terms of moving in this type of environment. Don't forget that brewing and beverages in total is a local business, and therefore some of these major disruptions you're seeing, it's not hitting the brewing industry in the same way as it's hitting other industries. And I think that's a core feature as well. So we do produce a local product that, due to the distribution cost, needs to be sold relatively close to the brewery. And that insulates us from many of the external shocks that we're talking about here.
It's a really interesting last point. Thanks, Jakob. Really appreciate your time. Jakob Aarup-Andersen, the CEO of Carlsberg. Okay. What else have we got coming up on the show? Some great guests. Darren Marr, HSBC Senior FX Strategist and Digital Asset Research Head, coming up very shortly. Aliki Rufiak, Robeco Portfolio Manager, joining us in the second hour, as will be Evie Hambro, BlackRock Thematic and Sector Investing Global Head. We're going to talk about mining costs, what is happening in terms of demand, what's happening in terms of input costs, all of those factors on deck when it comes to that Evie conversation that we're going to have in the second hour.
And here's what we're watching throughout the rest of the day. The AI summit gets underway in Seoul, in South Korea, of course. We'll watch that for you. The ECB's Christine Lagarde will be speaking at the World Economic Forum's International Business Council throughout the day. And on the US earnings front, we have Estee Lauder, Lowe's and Target. Some more gauges there on the US consumer. And at 7 p.m. UK time, we do get the Fed minutes, of course. So those FOMC minutes will be crossing. And, of course, the team stateside will be across all of that. It is reported as well that President Trump will host an event with tech leaders at 7:30 p.m. UK time. So waiting for more detail on that front.
Just wondering what we're going to get out of the minutes and whether or not those minutes feel quite out of date now. Anyway, as we say, we are going to be watching what is happening in the United States. President Trump pressing the pause button on billions of dollars of new tariffs on Canadian goods. Pausing maybe for 3 days. Skylar's paying attention here. We'll get the latest on that trade negotiation a little later. Plus, the EU's AI investment plans face steep hurdles with rising costs set to test spending commitments. We'll talk about that. But up next, it's Asian equities, a chip sell-off extending. We'll talk about what's driving the weakness. You want to join the conversation? You got any thoughts on what we're seeing in markets this morning? IB Plus, BB, TV Go is the function. This is Bloomberg.
South Korea leading a sell-off on Asian chip stocks then as rising bond yields exacerbated concerns over the large sums of cash being shelled out by big tech. Nasdaq futures also pulled into the Kospi's downward spiral. We're looking at Nasdaq futures down 0.3%. Let's bring in Bloomberg Markets reporter Anthony Stevens. Anthony, we've seen this story before in terms of sell-off when it comes to the semis. Does this time feel different to you?
This time feels a bit more macro to me, and that's why it's a little bit different. We finally have this transmission mechanism between higher rates and lower chip stocks, right? And one of the reasons for that is AI is starting to compete with itself on the risk-seeking side of things. So you have a lot of new issuance on both the debt and equity side. So let's talk about the debt first, right? We have a lot of hyperscalers coming to market here. You had Alphabet, you have data centers linked to Microsoft, you have SoftBank launching a retail bond in Japan, and this is all coming at around junk yields, right? So around 7. And those yields have been moving higher in tandem with like the belly of the curve and the long end of the curve in the US. So you have these higher yields and people can clock like around 7-8% on AI debt. that's very equity-like. It's very hard to imagine the S&P moving, another 8% higher in the back end of this year, right? So that's a lot of competition from the risk-seeking side. On the risk-free side, you also have 30-year yields across the entire world moving into that 5-6% range. So you have that competition from both legs of the liquidity trade, and that's pressing on chip stocks just as we start to get a higher probability that OpenAI and Anthropic IPOs are coming, right? Because they had these strong numbers, revenue numbers, and that's pretty much solidified the conviction in people that these IPOs are coming. And if they come anywhere near the kind of excitement that SpaceX brought, people have to make space in portfolios. So we are coming to a point in time now where the macro conditions are getting tighter, but the competition for the incremental dollar is going up. And that's why people are unwinding these semiconductor stocks.
Anthony, thank you very much indeed. We continue to watch, of course, the rout in the chip stocks. You're seeing that in South Korea. Of course, we'll see what the read across is to Europe. So far, European futures pointing down, but not by the same amount. Anthony Stevens in Hong Kong.
OK, what else do you need to know this Wednesday morning? China has taken a major step towards its efforts to match SpaceX's ability to launch and recover rocket boosters. This video clip posted online shows a rocket tapering its thrust to touch down gently. The rocket was developed by Land Space Technology, a private Chinese launch provider. While the landing is a big breakthrough, clearly, getting the booster ready for another launch is likely to be a significant challenge. SpaceX definitely struggled with that for a while. Ukraine's former defense minister has called for the country to find a way to hold elections during the war. Mikhailo Fedorov questioned whether Russia should effectively be able to determine whether Ukrainians can choose their next government. The 35-year-old was dismissed from his post last month, and his comments are widely interpreted as a challenge to President Volodymyr Zelensky. And the Trump administration has delayed 50% tariffs on billions of dollars of Canadian products for 3 days. The president announced the decision less than 2 hours before the new levies were set to take effect, saying the two sides had reached a tentative agreement. The Canadian Prime Minister, Mark Carney, wasn't as definitive, saying progress was made, but stopped short of saying that they had a deal. It's interesting. It has wider implications for Mexico, Canada, the United States.
Because we're talking about cars, we're talking about dairy, we're talking about alcohol.
And the Canadians, so two things about Canada and alcohol. One is which you can't buy at the supermarket, which I find was extraordinary, trying to figure, oh no, I've got to go next door to buy my alcohol. Yeah, but they've also banned US products there, haven't they?
Yeah, I mean, it's really interesting. Canada is one of the only nations that's gone, no, we're not just accepting tariffs, we're going to retaliate. Yeah. And it's not massive retaliation, but it means that we've had this very prolonged tariff negotiation. And Canada's actually been relatively unscathed because of USMCA exemptions, which means the tariff rate on average is quite low.
This is not hitting our resident Canadian, by the way. This isn't hitting oil, is it? Oil and potash and those commodities that Canada ships into the US. Those are exempt, aren't they?
Yes, I mean, I think the issue is there's more of a reliance on Canada than on the US than the US on Canada. In terms of exports to the US for Canada are 70%. The other way around, it's something like 15%. But the US is very reliant on Canadian energy, and Canada sends energy to get refined in the US. And so they don't want those taps turned off.
All right, there we go. That's the on-the-ground intel that we need. Coming up, we're going to get an FX check as well. The loonie gaining on the back of this tariff news as well, of course. President Trump delaying those tariffs on Canada. We're going to speak to HSBC senior FX strategist Dara Nayat. That is coming up, that conversation. Stay with us. This is Bloomberg.
Wednesday the 19th, half past the hour, which means 30 minutes to go until the start of trading here in Europe. Futures look a little bit like this. Here in Europe, not much happening. In the United States, a little more happening. Over in Asia, you've certainly seen a negative session, but the CAC's absolutely flat. The FTSE's absolutely flat. The Stocks 50 futures are down by 0.02%. So my guess is, looking at this board here, at index level this morning, we're not going anywhere in a hurry because we don't have any chips.
On the bond side, on a week when, of course, we've seen a sell-off, particularly at long end with higher yields, today a little bit of stability across the sovereign debt markets of the Eurozone. The German 10-year is currently at 3.25. OATs over in France have been grinding higher, those yields, but today yields are just down 1 basis point. And BTPs as well, continuing to stay above that 4% level, but just 1 basis point move lower in the session today. So a little bit of stability, but again, in a week we have had that sell-off. Let's go from bonds to what's happening in the FX space now and bring in Darren Meyer, Senior FX Strategist and Head of Digital Assets Research at HSBC. As we look at the dollar in the session today on the Bloomberg Dollar Index, down by 0.2%, so a lift there for the EM space. Darren, as we think about, as we look at the yield story and the sell-off at the long end, concerns about fiscal expansion, concerns that maybe the Fed isn't going to get a grip on inflation, what is the read across to the greenback on what we're seeing along those lines?
I think, well, I blame Liz Truss for all of this. Do you remember her?
Oh, this comes back to Liz Truss, does it?
Yeah, it is. It's Liz Truss's fault. G10 currency market, you never care about fiscal policy. I mean, unless it had a direct read across to monetary policy, then you can add a currency angle to a fiscal story. With Liz Truss and Kwasi Kwarteng, suddenly G10 could get angst-ridden on the currency side by nervousness about fiscal policy. We've seen it since around Japan quite recently. But what's quirky now is we're beginning to see it around the US, right? And I say quirky because the US has run twin deficits for, 50-odd years? And people have tried to make a bearish dollar case on the back of it. And it comes in and out of fashion. And at the moment, this angle is in fashion.
Is this time different?
We always say that, don't we? It doesn't, to be honest, I don't think it feels that different. What I think is curious here is that the currency market is normally built on the short end of the curve, right? What's the Fed doing vis-a-vis the ECB, the Bank of England? At the moment, we're having to kind of look much more towards the long end of the curve. Is there a dislocation here? Is there a structural story around the dollar? To be honest, we're not convinced. I mean, we're dollar bulls, so we're kind of having to take this on the chin at the moment with kind of some of this nervousness around US fiscal policy. But it's not unique to the US, right? We're seeing this dislocation of bond markets globally, and currencies are a relative story. And on a relative basis, therefore, I'm not sure that the dollar needs to be smacked quite in the way it has over the last couple of weeks.
I mean, something that also has gone in and out of fashion is the Sell America idea. And I think you've characterized Warsh's communication at July as a Sell America trade. Is that a long-term drag on the dollar?
Not really. I mean, now I blamed Liz Truss before, I blamed Bloomberg this time around. There is a tendency, I think, when we're doing day-to-day market commentary that we need to come up with some extended theme. And so what we do is we look at the price action over the last 48 hours and we go, oh, this is a Sell America story, and then we extrapolate it into some kind of 1 year or 2 year.
When you say we, who's we here in this conversation?
Market commentators. I mean, like me, but let's pretend it's Bloomberg, okay? Because that's who we all listen to. And so I think this is the danger, that we're extrapolating a couple of weeks of soft US data, some question marks, a transition period in Warsh, Powell to Warsh commentary. And I think we're weaning the market off this idea that the Fed gives us forward guidance. Now, the market reaction to that is we don't like it, and this is like poor communication by the Fed. But the Fed, I think, or at least Warsh will argue, well, this is, better get used to it. So it'll be interesting next week, what does he say, Jackson Hole, or a couple of weeks' time. But for me, I think the Sell America story comes out when the dollar is already weak, and we're trying to provide an after-the-fact rationalization for why the dollar's done what it's doing.
I mean, does that mean data and the Fed are very much the dominant drivers of the dollar? Because lately it does seem like the relationship with oil is weakened with that correlation coming down. Does that not matter as much?
Yeah, there's a couple of relationships that I'd say are less reliable. Oil, I think, is a good one that you cite. In other words, another one is the dollar's relationship with the equity market. We had become accustomed to the dollar being a safe haven. That's a less reliable story that we can tell. But what we can rely on, and increasingly over the last 2 to 3 months, has been the dollar's relationship with the Fed outlook. What I think is interesting, if you look at something like the euro dollar, right, and you say, it's all about relative rates, it's actually not. It's really all about US rates, right? The short end of the curve, historically, that's where it's been at. So I say euro dollar, it's got an American accent. It does not have a European accent. Dollar CAD has an American rather than Canadian accent, right? So this is the key. And, for the last short while, we've had some soft prints out of the US. I think the challenge for policymakers is, does that continue? And it's of course, not guaranteed that it will.
Talk me through the equity relationship. If we get significant volatility in US equities, do I buy the dollar or sell the dollar?
Yes.
Yes.
And I'm being flippant there, but the reality is you have to say, well, okay, it depends why, right? So,
Does it?
Yeah,
well, okay,
because,
tell me why.
Let's offer one route to that kind of volatility, by which you mean nervousness, right? Pretend it's the AI bubble, if we call it that bursts all of a sudden. That's a very US-centric story. So equity markets fall, but also we come to the sell USA story, right? So are we therefore buying the dollar because it's a safe haven inverse relationship to equities? Are we selling the dollar because AI is a very US-centric angle, and therefore if AI is in trouble, we should be selling US assets, including the US dollar? That's where the ambiguity comes from, right? It's not just a simple reflex of...
Okay. Resolve the ambiguity in that. If I am nervous about the AI trade, am I nervous about the dollar?
Yes.
Okay.
But it doesn't necessarily mean you'll be going out and emptying it and clearing out of your dollars. I think what you will be arguing is I need to find other safe havens. Ironically, Japanese yen in that kind of situation, right? It's a massively undervalued currency. Maybe it will capitalize. The Swiss franc, but then you'd have the SMB leaning against that. And perhaps gold would come back into vogue as a safe haven. But the dollar would be ambiguous. I don't think it's a clean-cut buy or sell on that particular angle.
You look at crypto as well.
Yes.
Is that potentially a safe haven in that environment? Crypto's what, about 63,000? It's flatlined since about June. It's down year to date. What's the story around crypto? Is crypto dead in the water at this point?
It's taking a pause. It's great. I read lots of headlines around Bitcoin, and still people say, some commentators are, this thing's going to, and then they just name a silly number, and then on the downside, this thing's going to, and
it has no
another
utility
silly.
At this point, does it?
No, but, if we did everything on the basis of utility, it has value because people think it's worth, I don't know, $64,000, right? So if somebody thinks it's worth $64,000, somebody's willing to pay it, that's what it's worth. That's what the market tells us. Is it a safe haven? To an earlier answer, the relationship between Bitcoin and things like equity markets to the US dollar has become very unreliable. And so the idea that it offers this kind of diversification angle is not something we can lean on as readily. So no, I'm not sure that would be the kind of the scramble. If you like, fiat's in trouble, let's all pile into Bitcoin. That would be my suspicion.
I mean, is another thing you need to think about when you have big equity sell-offs, though, just liquidity, right? Because if there's demand for margin calls, et cetera, that's very much a dollar play.
Yeah. I mean, look, if this is a generalized kind of risk aversion that we're talking about, so not an AI-centric potentially US angle, then I think the dollar does better, right? Because then, as you say, look, honestly, when the world is crumbling, what does everyone scramble for, at least initially, is they all scramble for a nice, shiny US dollar, right? We saw it with the outbreak of the US-Iran war. That was at a time where people were questioning the dollar's safe haven credibility, all of this. But when it began to unravel, everyone scrambled for the US dollar. So a general risk aversion story still plays very much as a dollar positive. A localized US question mark story plays, I think, much more ambiguous for the US dollar.
Darren, it's always great to see you. Thank you very much indeed for coming to see us. Darren Marr, Senior FX Strategist and Head of Digital Asset Research over at HSBC. Talking of AI, some investors are warning the AI concentration risk has spread now beyond equities and is definitely feeding into fixed income.
You can't just think about traditional factors or sectors or regions or even asset classes, because that AI tentacle is absolutely everywhere now, and that's only going to get worse. And so really important to stress test portfolios for an AI factor.
Tentacles. Gabriel Santos, Chief Market Strategist for Americas at JP Morgan Asset Management. More on the AI story next. This is Bloomberg.
Welcome back. We are a little over 15 minutes from the opening trade this Wednesday. European futures are currently flat, but within the context of a pretty significant sell-off over in Asia, that is possibly notable anyway. Flat as we look to the open in Europe.
Yep. Let's talk about what's happening with the inflation picture, particularly here in the UK. Accelerating in July, as expected, to 2.9%. Energy bills surging. This is a kind of a regulatory process we're going through. Did end, though, a short period of respite for hard-pressed British household. The jump largely reflects a 13% rise in the price cap that we use to set household energy bills. We're joined now by Matthew Bunny, UK economist for Bloomberg Economics. walk us through these numbers. This feels like cost-plus inflation. You've got external factors. You've got a lot of slack domestically. Is this the kind of inflation the Bank of England is going to take seriously?
So this is a good question. I mean, we saw inflation rise to 2.9% from 2.6% in July. That was in line with expectations. The main driver of this increase was higher energy bills. So this is the first time we've really seen the increase in wholesale prices flow through to energy bills in the UK. So that was widely as expected. Pushing in the other direction, fuel prices actually fell in the month alongside oil prices. Obviously, oil prices flow through much faster to fuel prices. Looking under the hood a bit more, so services inflation eased in the month, but if we strip out some of the more volatile components of services, it actually picked up a little. So there's some signs there of some stickiness in inflation. Looking ahead, we expect these cost pressures to continue to build. So we're thinking that inflation will continue to pick up in the second half of the year. Based on current energy market futures pricing, we're thinking CPI will peak around 3.3% later this year.
I mean, that's quite a high peak relative to target for the Bank of England, and the market's looking for a hike this year. Can they ignore that?
So our base case is for the Bank of England to remain on hold over the remainder of this year, reflecting that the labour market is loose. And to date, we haven't seen clear evidence that the energy price increase is feeding through into broader price pressures. It's also worth noting in the most recent meeting, some of the key swing voters on the Bank of England committee, including Governor Andrew Bailey, still appear to be some way from voting for a rate hike. Of course, there are clearly upside risks to inflation, and so we definitely cannot rule out the possibility of a rate hike. The key triggers we expect for that would be if energy prices stay elevated or if we start to see the CPI surprise to the upside.
We'll watch those very carefully. Matt, thanks very much indeed. Matt Bunny joining us from Bloomberg Economics on the latest data out of the UK. Let's turn to the wider market macro picture. Let's talk to Markets Live Executive Editor Mark Cudmore for his take on what is happening here. Mark, you talked about it yesterday, and it seems like it's happening. We're starting to see maybe a bid coming back into the bond market. Sustainable?
Short term, yes. I think we had enough of a sell-off for the last couple of weeks, given that most of the catalysts aren't new. They're just things are getting incrementally worse. And these are long-run stories. As you know, my structural view is that we'll see much higher long-end yields next year or around the world, or even later this year. I just think that it doesn't go in a straight line, and it requires kind of a shock to kind of get a move sustainably further than we got over the past week, because there are long-term income buyers out there, and they will kind of go into these dips. So once you started seeing that feedback into the equity market, that's a catalyst for people to kind of go, okay, right, it's time for me to put some more money into bonds at the margin. That's not a long-term strategy, but it does work for the short term.
If we have pressure off of bonds, does that mean we can buy the dip in equities and kind of move on with a summer vibe again?
Yeah, I don't see any reason to be particularly bearish. I think that the flip side of that is that who's going to rush to buy the dip when you're on holidays this week and there's low liquidity? So I don't think the dip gets bought as quickly. So I can see us, having a little bit more weakness in the days ahead. But it shouldn't be any reason to panic. I just don't see any kind of major negative catalyst out there. The big pictures around the world are, we still have massive AI capex. We still have wonderful company earnings. We still have massive both private sector expenditure from the AI capex and, of course, the fiscal side from governments. Growth is fine. And you know what? Yields are going higher, but they're still quite low. Financial conditions are still super easy. We're burning off some of that excess liquidity, but there's a lot of excess liquidity. The world is still wonderfully bullish stocks, and that's been the case for the last more than a year. There was a break when we had what happened, the Middle East situation, when we had the attack in Iran, and that was a real worry that could get very, very bad. It turned out it didn't get too bad. And so we go back to the underlying fundamentals are quite positive for as long as the AI capex bubble is in the inflation stage. And at the moment, it is still in the inflation stage. When that stops, it'll get messy, but it's not yet.
And Mark, that liquidity, is it enough to absorb the issuance, the debt issuance, the equity issuance, the sovereign issuance?
Yeah, look, we're starting to see higher spreads on the AI side. Correctly so. I mean, they were super low, and we're starting to, these are people are taking on a massive amount of debt over the last year or so. So we've had a big move in markets, but I'm not seeing any kind of panic in credit markets yet. I am worried, and again, this goes into the higher yield story longer term. I'm worried that we're seeing crowding out, and I think that the pressure from the AI debt funding on treasuries, I think, is slightly more problematic than the higher yields on what's happening to the AI space. So I guess the short answer, yeah, it's fine. We can absorb it. There's enough liquidity. Longer term, it might be a risk.
Bloomberg Markets Live Executive Editor Mark Cudmore. Mark, thank you. Remember, you can get up-to-date analysis and insight, of course, from Mark and the rest of the team. Just go to MLIV Go on your terminal. Let's get your stocks to watch this Wednesday. Alex Morgan with the details. Alex.
Morning, Tom. Yeah, we'll be watching to see if that chill breeze that we saw blowing through US tech stocks through Asia will be arriving on these shores this morning. It is expected that will be the case, keeping eyes on ASML, ASM, Infineon and ST Micro. We saw, of course, the semiconductor heavyweights really weighing in Asia. So eyes to the European chip stocks this morning to see whether or not, as I say, that sort of chill feeling comes through. Let's turn it over to Carlsberg. And obviously, you were speaking not long ago to the company's CEO. Quite a lot to unpick from this, both sector-wide and for the company. But it was soft drinks, really, that gave them a bit of a boost here. You can see round about 9% year-to-date up around here. I think it's fair to say that the news we got this morning about their earnings was roughly in line with what analysts had been expecting. The CEO talking to you about the impact of that severe weather in China. Analysts have been expecting that to weigh not just on Carlsberg, but the whole sector. Interesting, that pivot to soft drinks, and that is the broader story, really, for a lot of these brewers, not just Carlsberg, but Heineken and others. As consumers, particularly health-orientated, look to soft drinks, non-alcohol, low alcohol, you're seeing really a pivot there in their business models. Carlsberg getting a lift from that. So do keep an eye on Carlsberg at the open shortly. And finally, Doc Morris. That's a Swiss-listed online health portal and online pharmacy. Up year-to-date around 62%, doing well pre-market. Some of the top lines from them this morning. There is, of course, this ongoing cost-cutting at the platform. They narrowed a reported loss, which was slightly better than what analysts were expecting. So probably want to keep an eye on Doc Morris. As I say, doing well pre-market. We'll keep an eye on the tech stocks, on Carlsberg, and on Doc Morris as trading gets underway very shortly.
Alex Morgan, thank you very much indeed. We had a big IPO over in China, Unitree, which was one of the leading robotics makers, humanoid robotics. They could be shipping about 60,000 units. They're already shipping about 5,000. They could be shipping 60,000 by the end of this year. But wow, I mean, this is the dynamics of the Chinese market. A jump of more than 600% on the back of that IPO.
But aren't Chinese companies being told to price low? And therefore you get these kinds of pops.
Regulators are concerned about investors getting burnt, and so yes, they keep the price down, but that obviously has a cost for these companies looking to raise capital.
More equity. Here comes.
Yeah, I mean, absolutely. And there's a question, too, around are they all rushing now because valuations are high? Yeah. Yes, maybe that's not the case in China, but certainly elsewhere that's the dynamic that's played out.
I want to flag as well, there's a Barclays note out this morning. Barclays strategists raising their forecast for European earnings. This is Emmanuel Cao and the rest of the team. So they're now raising them to that number to 16% in terms of the forecast for European earnings, up from 12%. For the rest of the year. So they see a very strong back half.
You've been asking the question this week, is this as good as it gets when it comes to earnings?
The suggestion
says no.
Yeah, Barclays, definitely. And many others are saying that as well.
I mean, it's very worrying, though. You have all of these news stories around hotter weather, inflation, growth being under pressure. But the second quarter earnings were very strong. And so there is a question of how long does that go on for?
Is this peak earnings? Like maybe we're not quite at the peak, but maybe how close to the peak? Because historically, you look at these numbers, they're extraordinary.
We need to get Emmanuel Cao on to unpack what is underpinning that confidence in the margin story, in the earnings story, in an environment where we are seeing all these costs rising, and we know that Europe is not immune to that.
And I mean, that's what we've seen repeatedly from CEOs that have been on, is that there's worries about repeated supply shocks. You have to take that into account now in terms of how your company's functioning. Yeah,
but they all say they're getting used to it, and they're all saying they're able to deal with it, and you wonder whether if you take them at face value, and that is true, then then actually they're able to weather the storm. This is the line that stands out to me. Higher nominal growth remains a key tailwind for EU earnings, while oil prices are supportive and FX has turned into a modest tailwind as well. So there's a few things blowing in Europe's direction.
I mean, I wonder when the yield story starts to play a bigger role, though, in terms of yesterday, I think the yield rise definitely had more of a feed through to European equities. Yeah. And, you know, the expectation is the ECB is going to hike to the top of neutral, but now we're going above that top of neutral range. So you do get pressure on growth eventually from that angle.
Right now, European futures are pointing higher by about 0.1%, which in the context of the sell-off when it comes to semi-stateside and in Asia,
but they've been pointing a tenth either side of the flat line kind of for days now. Volume is very, very light as well. We just want to point that out too. Anyway, the opening trade is coming up next. We'll show you some numbers. This is Bloomberg. Welcome back. A couple of minutes to go until we start equity trading here in Europe. Lots of volatility in the States, chip stocks. Lots of volatility in Asia, chip stocks. Europe, not so much. We'll see what ASML does this morning. But broadly, that is the narrative. This was the session here over in the United States yesterday. Europe went out not too far away, actually, from the lows of the session, which came towards the back end. But the Philadelphia Semiconductor Index was off sharply yesterday, which has kind of fed into the Asian session. You're certainly seeing that in the Kospi, but it's unlikely to feed into the European session. Let me show you some numbers out of Europe. They are a little bit more benign. Stocks 50 futures, 0.2% to the upside. FTSE's up 0.1%. DAX futures up 0.2%. You're getting 5% moves in the US. You're getting 5% moves in Asia. Europe, not so much, Tom.
OK, you checked on the chip story, of course, and we will be zeroing in on the potential read across to the tech space then in Europe. You mentioned ASML. We'd be watching, of course, names like ASML, names like ASM, ST Micro, of course, Infineon as well, to see if there is a read across in an environment where European futures are pointing high by 0.2. Carlsberg in focus, of course. We've been speaking to the CEO. They have upgraded or edged up the outlook, nudged up its outlook on the back of strong soft drinks demand. So we'll be watching that company. ING, this is a story around trimming its stake in a bank called TTB. So ING cutting its stake. We'll be watching that stock as well, Guy. Financials in focus.
OK, here we go. European equity market open. Feels like it's going to be a fairly quiet kind of story relative to the global turbulence we are seeing out in Asia, in the United States, as I say. And you do wonder whether or not this is a feature, not a bug this morning in terms of what we are seeing. OK, let's give you some numbers. What are we going to be seeing? Are we going to see tech stocks sell off? What are we going to see in oil stocks and miners this morning? I think will be interesting as well. OK, FTSE 100 out of the gate, up as expected. Let's call it 0.1%. I'm being slightly generous. We're mid-August. Let's be generous. We are flatlining, basically, in London. We're expecting a very similar picture elsewhere. Stoxx 600 is doing something similar. FTSE's now flirting with positive and negative territory. We're going nowhere at an index level. The CAC, the DAX, the AEX, the IBEX are all expected to do something similar. Below the surface, though, interesting things might happen. Are we going to see some underperformance from the AEX? No, we're not this morning. There you go. That's interesting. So I'll be interested to see what ASML does. But the IBEX is doing nothing. The CAC's up by 0.2%. Tom, what do you got below the surface? What's going on there?
Well, just touching on ASML right now, because that is actually up 0.4%. So that is interesting in the context of that pretty significant sell-off in the semi space. ST Micro is down 0.8, though, on the flip side. In terms of what is happening across your sectors, basic resources is currently your leading sector, up 0.5%. Media is seeing the biggest losses, down around 0.3%. Chemicals on the other side of the ledger, seeing very modest gains of 0.3. Construction also up about 0.3%. Travel and leisure gaining so far in the session, just 0.1%, and energy is there with oil prices, of course, at around $91 a barrel. Tech as a sector is down 0.2%, so it's amongst the losers. But again, ASML is holding its head above water with gains of around 0.6%, Guy.
It's the biggest points gainer in Europe. You don't need to see much of a move with ASML to keep kind of things looking actually fairly rosy. I'm curious as to why. It's interesting because you've got Infineon down, you've got some of the other chip names down. The pharma sector looks like it's under a little bit kind of more pressure, but it's mixed. Astra's up, Novo's down, Nestle's down, but some of the other staples are doing slightly. I'm struggling to see a clear narrative emerging out of Europe this morning. This feels more like an August kind of picture in front of me here rather than anything else. Elsewhere in the world, there's clearer narratives, I think. Europe, I think, not so much.
Yeah, I mean, I think gilts are very much following the global story until we have yields down this morning at the 2-year point, on the 10-year point, and that very much follows what we've seen in Europe and the U.S. with this kind of stabilization with yields, and kind of contrast for what you saw from inflation data this morning, where, yes, headline was in line, but it was a rise, and I think more concerning for the Bank of England was that we got core CPI higher than expectations, even if it was flat. And the pound rallied on that. So maybe the gilt move is more to do with global expectations rather than what happened with inflation this morning.
We were talking about the buyback story, SK Hynix, during the break. And so the redhead across the terminal right now, SK Hynix shares erased those losses of 8.3% post-market on that buyback story. So returning pretty significant capital to shareholders, SK Hynix. At this moment, of course, where we've seen that stock started the session down double digits, repaired some of those losses then post-market as they look to return cash to shareholders.
Take money off the hyperscalers, give it to your shareholders. And to your, as you pointed out, also to your workers as well, which is an interesting story as well. But that seems to be the flow at the moment. Hyperscalers, cash flow negative, spending a lot of money right now. SK Hynix, one of the big beneficiaries of that. How they use that, I think, is interesting. Do they use that to increase capacity, which could have an increase in terms of the pressure later on, or do they just give it back to shareholders?
Well, the other way to read it would be they're not putting that cash to play in capex.
Yeah,
so
well, that's
maybe they're starting to see exactly. So maybe they're starting to see. But so far, investors seem to be welcoming the return of capital to shareholders. Let's get a broader take on these markets then, and bring in for further analysis Alika Rufiak, who is portfolio manager over at Rebecca. Alika, good morning.
Good morning.
Thanks for joining us. You lent into risk, so you've upped your risk in the month of July, and that, of course, was a month when we saw a significant sell-off. Do you remain confident that you want to be leaning into risk, leaning into equities at this point? What is giving you that confidence, if you have it?
I think if I take a step back and look what happened over the last couple of days is, again, we see the same narrative that equity markets are kept hostage of the conflict in the Middle East, right? We've seen rising bond yields and some weakness, some softness, particularly on the tech sector at the back of higher bond yields. However, on the other side, we have also seen very strong fundamentals, right? The quarterly 2 earnings have come very strong, both in the US but also Europe. So we've seen better earnings expectations there. And for us, what is also important is the fact that earnings growth is broadening out outside the tech sector. So other sectors are contributing to this more positive picture. If I look then at the inflation front and assess a little bit the situation there, because obviously inflation is a risk and is a risk to earnings if it becomes sticky. And at this point in time, I think we are in a very different environment and very different narrative compared to 2022, when we saw inflation rates shooting up. And we also had a very supportive second round effects that effectively supported central banks to increase rates at a much faster pace. For now, we think that second round effects are relatively muted. If I look in the US, latest employment numbers outside on the payrolls front have been weak. So weakness in the employment market is not boding well from a growth perspective. But also the inflation prints that came out last week, both on the consumer and producer side, have been broadly in line or below expectations.
Okay, so there's a lot to unpack there. Can I just focus on the here and now?
Yeah.
The sell-off that we've seen overnight in the US and Asia with chip stocks, would you buy that dip?
So we favor emerging markets as part of our overall kind of like more pro-risk stance, and I think there we're selective. And we are selective because obviously AI has contributed quite a lot in terms of driving emerging market returns since the beginning of the year. But what we've currently seen is that the market is starting to differentiate between kind of the different regions, and particularly with regards to their exposure to the AI theme. If I look at the different countries, Korea and Taiwan come to mind. They have been like predominant drivers of performance. And from our perspective, we like the space. We think that if AI capex continue to be very strong, this would also support equity markets vis-a-vis that the earnings coming in line with expectations for the very high valuations of the space. But we are also deploying active management approaches in order to be able to navigate this more volatile environment.
Higher bond yield is going to be a problem for equities. The equity yield is disappearing rapidly at the moment. Why do I need to own equities when I can own bonds at these kinds of levels?
I think on the yield perspective, they are, if we look at the catalysts that they have driven rising bond yields, there are two stories. The first one is very high real yields. So that's one factor that is underpinning higher bond yields. And the second one is the increase in term premia that we've seen in the market, particularly in the US. And there the market is focusing more on the fiscal situation. Sure. So higher fiscal risks that could point towards higher yields. For us, what is built in from an inflation perspective, so the oil price shock and expectations for higher inflation is likely to be transitory, right?
Sure, but those first things you mentioned aren't. If we're worried about long-term debt sustainability of governments and you've got a crowding out effect coming through from AI, yields are going to stay higher. Do I need to revalue equities off the back of that?
Absolutely. I think it depends on growth. And when it comes down to growth, at least what we've seen in Europe, the narrative is a bit different. Markets were expecting growth to be weaker during the US-Iran war. The data have actually surprised on the upside. So from that perspective, we see growth coming in a bit better than expected on the European front, at least. And on the other side, we've seen the broadening out of growth expectations on the earning front. And this supports that returns are going to come from on equities from other parts of the universe. So the AI is a kind of like a predominant story. And for us, index concentration is a risk. So the way that we access equity performance is kind of like towards from a more diversified perspective. We are also focusing on factors that are likely to outperform during a higher rate environment. Value is one, and we are also looking for style diversification, so fundamental strategies, but also combined with quant strategies where you can also harness this factor premium in a more efficient way.
When US-Iran, the conflict first began, both bonds and equities sold off together. How do you insulate or hedge portfolios against those repeated supply shocks?
We do see that over the short term, and given the fact that we have a re-escalation of the conflict in the Middle East, that equity-bond correlation is becoming positive. So we have added some tail risk hedges in the portfolios. One is the Norwegian krona, which is an oil-sensitive currency. And on top of that, it provides us with a positive carry relative to the euro, which is what we are playing Norwegian krona against.
We've had this massive compression between EM yields and DM yields. Is EM compensating you for the risk? Is it just the fact that EM isn't as risky relative to DM as it was previously?
So from an EM local currency debt perspective, we are more positive in the medium term, and this comes at the premise of a weaker dollar. We've seen very recently the repricing of Fed rate expectations towards kind of like a more cautious dovish stance, and this has supported the space. We also see during a high interest rate volatility environment that the emerging market local currency denominated index has a lower duration compared to the global government index, and that helps us also to manage that exposure with regards to interest rate risk better.
Likia, nice to see you. Thanks for stopping by to see us. We really appreciate it. Thank you very much indeed. Likia Rufiak, Robeco Portfolio Manager, joining us here in London. Call 6 looks like this. As we've already indicated, ASML not succumbing to this big chip sell-off that we've seen around the world, certainly in Korea overnight and also in the United States yesterday. In fact, it's up by circa 0.5%. Schneider's a little softer, though. You are seeing some of the defensives performing. Nestle is up. Some of the pharma's very mixed this morning. LVMH doing nothing. Let's get other moves that we are watching. Lots in the chemical sector this morning. Plenty of other sectors to watch as well. What's Alex Morgan focusing on? Let's find out.
Well, let's kick off with Carlsberg then, shall we, Guy? Obviously, that's been one of the main earnings stories this morning, down around 1.5%. Now, this is obviously, specific to this particular firm, this company, but also the broader sector challenges we were talking about for brewers, for drinks manufacturers, as people turn to low and no alcohol drinks. But Carlsberg opening down this morning, that, of course, talked about the challenges, the double-edged swords, as the CEO put it to you, about heat waves, obviously driving up demand in one sense, but obviously causing all sorts of other challenges on the other side. So Carlsberg off the back of all that this morning, down nearing now 2%. Let's turn to Geberit, the German sanitation manufacturers. You see them in commercial and obviously in people's home bathrooms, sinks, pipes, etc. Opening up around 7% this morning off the back of their second quarter profit, which was above estimates, gaining, as much as 8% this morning for Geberit. Doing well and in the green. Let's turn it over to Straumann. Now, they are the manufacturers of dental implants. This is an interesting one, down around 7%. Now, the news from them this morning, they reported profit for the first half of the year, which had beat the average estimate and named a new CEO. However, opening down and in the red for Straumann this morning. One to keep an eye on, maybe to unpack that one a little more. And finally, let's turn to Ambea. They are a Nordic health platform online, up around 10% this morning, really doing quite well on the back of that company's news this morning. So a blend of the green and the red, folks, but Carlsberg, obviously the main talking point that's been on the programme, that is down, and they are in the red this morning.
Alex Morgan, thank you very much on some of the stocks on the move this Wednesday. Coming up, more on those Carlsberg results then. We're going to bring you the highlights from our earlier interview with the company's CEO. That's next. This is Bloomberg.
Okay, here we go. 17, 18 minutes into the session thus far. This is what we're looking at. Unchanged is the takeaway from that board, and we've kindly written it for you. We are doing nothing. In terms of the sector story, construction, basic resources, energy are up on the downside. Banks, real estate, and media in terms of the sectors that we are watching. We don't have a great weight in terms of tech. It was interesting to see, though, that ASML did not fall in line with the chip story around the world. I do wonder whether or not that's maybe partly down to what we've seen with SK Hynix recovering over the last few minutes.
Yeah, and the details after the close over in South Korea, after it faced, of course, significant pressure in terms of the share sell-off. The details coming through on that is that SK Hynix has announced a $28.6, let's call it $29 billion share buyback plan as the company generates record cash flows amid the AI boom. Let's get the details, bring in Bloomberg senior strategist Neil Campling. Neil, what do we know about the buyback announced from SK Hynix? Is it going to put a floor under the share price? Is this a tell in terms of how they plan to approach things going forward?
I think the market had been expecting a buyback, and given the record cash flows, it was kind of they had the fiduciary duty, I suppose, to announce that. The talk last week about potentially one of the highest regarded sovereign wealth funds potentially taking a stake in Hynix and Samsung probably adds to the buy case for the stock, perhaps. But it doesn't remove the fact that the volatility around the stock, around the market, around chips is going to continue, I think, especially because there are, I think, a lot of, should we say, tourists in the stock rather than fundamental owners of these kind of
should
shares.
we put the latest sell-off in chip stocks down to volatility? Is it something more macro? What's really the driver here?
I think there is a macro point that we have to keep in mind here, which is that we have free cash flows from the hyperscalers turning negative in the outlook. They're coming to the market and they're raising debt. So that also leads to the weighted average cost of capital going up for the equity. And so there are all these issues, and when you see the long-dated treasuries moving higher, as we've seen in recent weeks, that creates pressure points that weren't really here for tech for the last decade or so.
Well, we can blame the tourists. The market likes robots.
Yeah, it does, and in terms of robots at scale, China has been actually in this area way beyond any of the other sort of companies in the US, etc. So there is appetite, particularly in the Chinese
This is the
market.
Unitree IPO that's come through this morning. Was it 600%?
That's right, yeah.
They kind of, as we were talking earlier, the Chinese authorities, though, are kind of pricing these things, arguing that they should be priced low, so you get a nice pop.
Price to go and then pop, and then, but then, of course, I suppose then the thing is what happens further out from that. Can it maintain the share price up at these levels when you have a lot of retail interest in these kind of markets? And And that's where we obviously seen pressures in South Korea. So let's see what happens in the Chinese market.
Neil Campling, covering robots, tourists and everything else in between. Thank you very much indeed. Carlsberg shares a little lower this morning after the Danish brewer narrowed its full-year growth outlook towards the upper end of its range. After a strong performance in soft drinks in particular helped underpin the sales volume in the first half. We spoke to the company's CEO. He emphasised on his ability, his firm's ability, his team's ability to deliver on the guidance.
We are basically almost through the big summer season across our key markets, and therefore we have a lot of certainty around the delivery on those key big months for the beverage industry. That gives us a lot of confidence in our ability to deliver on this increased narrowing of the guidance that we've just come with today.
Let's go to Copenhagen and talk to our bureau chief there, Sarah Scholin. The stock's a little softer this morning. The earnings, the guidance looks pretty good. They've narrowed that. What am I missing here? This looked like a reasonably positive picture, but the market's taking a little bit of fright. So what should I be taking away from the earnings?
Well, you're right, Guy. It's a perfectly decent report, but I would think it's lacking a spark. It's lacking something that's going to get everyone super excited about the outlook now. As Jacob Aarup-Andersen said in the interview earlier, they have a pretty good visibility of the second half of the year, and it looks nice. It's within the guidance, but they didn't raise the guidance. There was no expectation of that, of course, but there's nothing to say like this is a company that's just going to knock it out of the park, but they're doing pretty well. As you also said, soft drinks was one of the highlights. That's really what's driving the growth in the second quarter this year. Mainstream beer volumes were largely flat. The CEO pointed out two things in the soft drink area. It's the Britvic integration is going really well, and that's also helping support some of this sales growth. They are integrating the company faster than I had anticipated, so they're looking at 80% integration of synergies by the end of this year. This is more than they had said earlier. He also said the Pepsi partnerships are doing really well, and a lot of the soft drinks volumes are driven by Pepsi sales. And I was just on a media call before getting on this show, and the CEO said that they're likely to engage in more Pepsi partnerships in the coming years, although he couldn't say specifically which one or if it was a certainty. China has been a big drag this quarter. We talked a lot about really bad weather in China, and he said like it's just like they're a lot weaker than expected, and it's something because of high inventories now that's probably gonna go all the way into this third quarter of this year, where they're gonna see maybe some weaker sales in China.
Yeah, so the weather clearly a challenge in China. He was pretty explicit about that. What about the heat waves in Europe and how that's impacted the business?
Well, it's a bit of a two-edged sword, really. I think a lot of people are inclined, me included, to go to the pub when the sun is out. We're going to have a pint more or 2 pints more when we have really nice weather. But when it comes too hot, there's a point where people start tipping over into just drinking tap water, not even soft drinks will do at that point. And we've seen some of that this summer. There's also been some festivals where they put a ban on alcohol just to get people to drink more water and soft drinks. But overall, for this quarter, it's seen as a positive for Carlsberg because the weather has been nice across most of Europe, so people have come out to drink more beer and soft drinks.
Okay, Sarah Scholin, restrained, I think, in your consumption maybe of beer in the face of the heat that Denmark's been facing as well. Sarah, thank you very much indeed for the breakdown of what we've seen from Carlsberg. As we've been saying, the stock is a little lighter so far in the session. One of the other headlines for the day really should have been Red Banner. It has rained in London.
I would actually quite like the idea of standing outside in the rain with a beer in my hand. That sounds like quite an attractive option at the moment.
Not something we'd have said 6 months ago.
No, definitely not.
Shocked when I ran to the car this morning. I was like, what? It's raining?
What is this stuff that's coming from the sky? Yeah. Long may it last. I may regret saying that, by the way.
Yes. Well, there's some reporting suggesting that we're going to face significant storms in the winter, rising sea levels. You've been dipping your toe in the ocean.
Rising sea temperatures.
Sea temperatures, not levels.
Levels may come, but temperatures are up.
And levels may come over the winter. So Europe may need to brace for some pretty significant storm action over the winter. Again, there's some Bloomberg reporting on what this is doing.
And I mean, it never lets up, right? In terms of if you have it in the summer, if you have it in the winter. And I do wonder who bears the cost of that. Is it the consumer? Is it companies? Or increasingly, is it governments that have to spend to insulate the fact that you're going to have these natural disasters?
All of the above, though, isn't it?
Yeah.
That's just the story. And you think about, keep coming back to it, the food industry. Terrible summer. If it rains a lot, terrible winter.
Yeah,
both of those two things.
Late planting season.
Yeah. So Food prices go up, food prices stay up, the rate of inflation just increases, starts to get embedded, you get second round effect. That's the kind of scenario we hope doesn't apply here. But so many of the CEOs that we talk to that come on, this is what they talk about. We are now used to this. That's the turn that we're working with.
And crop prices are already very high right now.
Yeah.
And we were talking with one of our earlier guests about EM versus DM. And this is very much my worry for EM debt, is the fact that you have a higher share of the inflation basket that's food. And so, eventually you get that feeding into inflation expectations. De-anchoring happens more quickly there.
The bulls may lean on the argument that, look, we continue to underestimate the ability for corporates to adjust. Yep. To have that resilience, and that they've learned from all of these different shocks, and that resilience is now built in at the corporate level.
We'll talk about we'll talk about this from another industry perspective. We're going to talk about this next, about the mining industry. Energy's kind of circa 20%. Labour's a pretty big input cost as well into copper mining, etc. What does that mean in terms of future prices going forward, in terms of the cost of production? Anyway, Evie Hambro is going to be here. We'll talk to him next about that. This is Bloomberg.
Happy Wednesday. This is the opening trade. We are 30 minutes into today's session. So after 5 straight days of losses for European stocks, you're currently flat across the benchmark. Of course, significant selling overnight in Asia and the US when it comes to the chip names. But so far, that hasn't really percolated through the European space. The DAX is currently holding flat as well. Modest gains coming through for the CAC current. Gains of 0.3%. You're largely unchanged on the FTSE 100 as well, adding just 6 points at 10,734. Guy.
It's August the 19th. I bring that up because we're mid-August, and that volume number probably speaks to the idea that we are mid-August. That's the narrative. Higher 260, 319 down. I don't think there's anything really convincing there in terms of the makeup of this market. Sectors are actually quite interesting, as are single stocks. So let's talk about some of the single stocks. FL Smith is a mining equipment company, beaten a raise this morning. Market likes that. Let's go from equipment to plumbing equipment. See what I did there? Gilts up by 7.44%. So this is the sanitation company. You probably see the name every time you go to the washroom. It's EBITDA beat, certainly being welcomed as well. And talking of plumbing, Frontline Shipping is doing very well this morning, near a 15-year high in terms of freight rates. Hormuz is the factor here. This is a company who's benefiting from that. I tried to find a link. I'm not sure I succeeded in all of that. Let's talk about Carlsberg. It is out with earnings this morning. We spoke to the CEO a little bit earlier on. The numbers look good, but there's no, as Sarah was saying earlier from Copenhagen, there's no real spark here. And I think that's why the stock is down by circa 2%. Smith & Nephew is down a little bit as well this morning. Its CFO is exiting the business. And Soitec, I'm just giving you an example maybe of one of the chip stocks that are under pressure this morning as a result of the sell-off we've seen out of the US and out of Asia, Tom.
OK, here's what else you need to know this morning. Oil is trading higher for a 4th day after President Trump insisted there are no ongoing talks with Iran, the standoff leaving the Strait of Hormuz in limbo then, with traffic still a fraction of pre-war levels, of course, as Washington prepares to ramp up economic pressure on Tehran. UK inflation accelerated in last month after energy bills surged, ending a short period of respite for hard-pressed British households. Consumer prices rose 2.9% from a year earlier, up from a 15-month low of 2.6% in June. The Trump administration, meanwhile, has delayed 50% tariffs on billions of dollars of Canadian products for 3 days. President Trump announced the decision less than 2 hours before the new levies were set to take effect, saying the two sides had reached a tentative agreement. Canadian Prime Minister Mark Carney wasn't as definitive, saying progress was made, but stopped short of saying they had a deal. It's to spend $30 billion to build 7 AI gigafactories across Europe, but Bloomberg Intelligence data estimates the EU will need to spend at least $3 trillion by 2035 to be truly self-sufficient in technology. Joining us now is Chief Europe Correspondent Oliver Crook. Ollie, what does the path to AI and tech autonomy in Europe then look like realistically?
Yeah, so listen, we've got some research out from Bloomberg Intelligence, which helps us sort of pave a little bit of a roadmap to what that would actually look like, and critically, Tom, how much that would actually cost. And the number that they've come up with, as you mentioned there, is $3 trillion worth of spending across the entire ecosystem through 2035. Now, very helpfully, they've sort of broken it down into the key sectors, which we can go through now. The main one, the biggest spend, is going to have to be that cloud infrastructure. $1.5 trillion worth of investment over the next few years will be required there to sort of cut back on its dependency, specifically largely on the United States. The semi-cap equipment spending upwards of $500 billion there. We should say the Europeans do actually have some strength and some autonomy in this sector on some of the semiconductors. They're mostly the analog for industrial capacity. They're used in cars, they're used in sort of the sort of smart technology within our homes, but not so much for those AI key chips that will require additional spending in Europe to the tune of about $500 billion on foundries. There is, of course, the question, Tom, about the large language models, a topic you spent a lot of time covering. $300 billion worth of spending required there. And you can really illustrate why that is when you look at the sort of market share that the Europeans have in terms of those large language models. They only have one really significant player, that is Mistral. And if you look at the sort of market share in 2026, that is only about 11% of the market, as you can see there on your screen. Of course, the one point where there is actual dominance in Europe in this ecosystem is, of course, for those lithography machines. ASML really down to one company. This is really where Europe has some leverage within those discussions about kind of that tech ecosystem, and something that really the entire ecosystem cannot do without. That being said, if you were managed to mobilize all of that money, get some harmonization across regulations across all these countries, that $3 trillion worth of spending, that would still only take you part of the way to autonomy. So it's a very long path ahead, indeed, if the Europeans want to achieve tech autonomy.
Yeah. They've got to be able to pay for it. Christine Lagarde this morning saying, I think she was in Geneva, saying that Europe can't be left behind. But can Europe kind of catch up at this point, Ollie? How much is it going to cost to catch up?
It's going to cost, $3 trillion just for the technology. But again, Guy, you're going to be talking about a lot of different sectors where the Europeans need to catch up. And if $3 trillion sounds like a lot of money you've got to spend, Bloomberg Intelligence has done the research that in order to gain basically full autonomy, you need to spend $14 trillion over the next few years. And that will have to do with the investments in defense, in energy generation, the power grid, all of the other sort of sectors. And particularly when you think about kind of what is the budgetary triage, when these governments need to sort of select what they're going to spend money on, what is going to be number one? Obviously, the welfare state is going to be one of the huge things that they really going to have difficulty cutting back on politically. Obviously, defense takes center stage. So there's a real question about whether or not the AI and technology is going to be at the number one in terms of the need for investment. Obviously, it's very important for economic growth. We were showing the chart there just a little bit earlier. It wasn't so long ago that the European economy and the American economy were quite comparable in terms of their size, but also in terms of their productivity. What we have seen in recent years, thanks to this technology story, is that those growth stories have completely blown out. You can see they've completely come uncoupled. So if the Europeans really want to catch up on that growth questions, there are going to have to be some very big conversations about where they're going to spend their money. And particularly now, as we're talking about borrowing costs, the highest they've been since the financial crisis, that spending story is not going to get any easier here in Europe.
There's a lot of savings. You just got to convert them into spending or investments. Ollie, thank you very much indeed. Oliver Crook joining us on the AI challenge in Europe. Talking of AI challenges, metals, many of them critical for the AI revolution. And their prices of these metals have been skyrocketing. Joining us now, Evie Hambro, Global Head of Thematic and Sector Investing at BlackRock. Good morning.
Morning.
Basic resources have done well this year. Metals have done well this year. The basic resources sector has done well this year, but a lot of that's come from the steel sector. I was looking through the numbers this morning, and I was surprised that names like Antofagasta and Rio haven't done better on the back of these rising metals prices and the margins that these companies are producing. Am I missing something here?
I don't think I'm missing something. I just think we've just got divergence in performance. So, you mentioned Rio Tinto, but then you look at BHP, it's done twice as well.
Yeah. Why is that? So why am I getting this divergence?
Well, it's down to the difference in commodity mix. So these companies produce different metals, and the different metals have derived different performance outcomes. So you mentioned the steel names. they've been absolutely fabulous this year, and they've been through a real kind of renaissance over the last kind of, I guess, decade in terms of their performance. So, obviously you've got some tailwinds, European legislation, the carbon stuff, China imports and the tariffs and so on, buy local, and then you've got this massive, you've just been talking about the 3 trillion that's got to be spent, or 14 trillion that's got to be spent. That's not going to be spent on thin air. It's not all going on chips. There's going to be an enormous amount of infrastructure that goes into. So whether that's power and batteries and cables and transformers and switchgear and all the buildings.
Isn't that all
and
in
so
the price already?
No, definitely not. No,
Okay.
We've got a long way to go. And I think one of the things that I think I mentioned on a previous attendance here was the thing that had frustrated us the most is that you've got the kind of the shiny toy that everybody's looking at, that everybody talks about, which is technology, data centers and chips. And none of that functions without everything else that feeds into it, the kind of supply chain that goes into it. The multiples on the companies that are the shiny toys are enormous, whereas the multiples on the companies that are attached to the same trend but are just not as exciting were a fraction of what the end outcome is. Still attached to the same demand path, same growth trends, etc. And in many cases, higher resilience when it comes to their profitability, with stronger moats around those businesses, yet trading on a de minimis multiples relative to the ones that everyone's focused on. We're starting to see that re-rating. If you look at some of the charts that we use on your systems, you can see that change in re-rating coming through. So, we talked about some of the diversified companies. The leader BHP has gone from a kind of 4 times EV/EBITDA multiple to an 8 times EV/EBITDA multiple. Now that's not what it used to be. It used to be 12, 20 years ago. So there's still room to go. So in answer to your question, absolutely.
On the supply side, are you worried at all that a lot of these critical mineral productions, including copper, is concentrated in emerging markets?
No, it's not at all. I mean, the minerals come from where the geology is, so you can't move the mines. So the supply chain is the supply chain. I think what governments are most worried about is where they're going to get their minerals from. So you take the EU, for example. How many mines are there that produce these key commodities situated in the EU bloc? Very, very few. So the EU has massive dependency on supply from other countries. And so, yes, at a political level, from a national security level, there are clearly concerns, which is why you're seeing all this legislation around critical mineral supply. It's why in the US is providing so much capital to bring back production and conversion of commodities into useful products into the domestic US. And that capital is going to unlock supply through time. But it's going to take many, many years for this to happen.
I mean, I guess part of the equation, too, is that you get this resource nationalization, you get critical minerals used as a negotiating tool. On that front, how has China's role changed within the commodity market?
China remains the largest consumer of commodities in the world, and they are the world's supplier of many of the manufactured commodities. So the things that, rather than the pure commodity that sits in the ground is converted into something that is then converted into a finished metal, China does that second stage, a lot of that second stage. So they have huge market share, especially in some of the metals that none of us know that we use every day. The rare earths everybody's talking about and so on. So there is a weaponization of commodity supply, and I think China has been very efficient in being able to use that as a negotiating tool. Hence the response from other countries around the world to try and protect themselves from that.
Copper's been up, double digits year to date. We're just below 14,000 today, so it's a little softer in the session today. There's been apparently a delivery to the LME. Given the tightness, though, in the copper market, what are you hearing? What are you seeing in terms of the miners about getting more supply? What is the ability to add more supply to this market given the demand and the constraints?
Yeah, I think those handlers at the warehouses must have a bit of a shock seeing metal coming in. Most of the
metal's been going the other direction,
it's been going out. So no, I think the market is very, very tight. And I think that there is obviously speculation around what the tariffs are going to be in the US and the flow of material into US warehouses, the massive shortages and very, very low levels in the rest of the world warehouses. And that's created this tightness, and you can see that playing out in these premiums for immediate delivery. There are clearly some games going on. Maybe things are a bit more acute than they probably need to be, but the trend is very much your friend in this scenario. If
the tariffs don't come through from the US, because all that stockpiling that we've seen into the US, does that collapse the price?
Yeah, well, we saw that movie last year. There was speculation around the tariffs. The prices went to very, very elevated levels. The news on the tariffs came out. It wasn't what people were expecting. Prices came back, and then they've done nothing but kind of move higher. And I think it's the trend in the market. The other stuff that sits around the short-term pricing is noise. The trend is absolutely your friend here. So you look at the trend. What's driving the trend? It's declining grades at existing operations. It's tired, very, very old assets. It's a lack of new development of supply coming into the market. It's the very, very long time it takes to bring on new supply. It's the challenges that existing assets are facing. And you've seen the big headlines out of Codelco, where the new boss of Codelco has come out and said he's going to prioritize profitability over production. And he came out and said, we are not going to meet our production goals. That is a massive statement from one of the world's biggest copper producers. And the market's kind of absorbed this news, and prices have responded to that. So we are seeing a very, very tight market. And it's very easy to say, well, OK, it's gone up a lot and we should ignore it. And it's too late. The reality is, if you've done that, you've missed out.
What about the cost of production? Diesel prices are up massively. I'm assuming a lot of the machines in many of these mines run on diesel. Electricity prices are up significantly. I'm sure they use a lot of electricity. Sulfuric acid up a lot. What impact will these have on margins, or is the price moving faster than input costs?
Yeah, so some commodities, the price is definitely moving faster than the input costs. You haven't mentioned labour. Labour's gone up as well. So there's definitely a cost pressure within the industry. And, but that's not new.
It feels like it's accelerating, though.
It is definitely accelerating, but some of it's probably short term. If we get a resolution in the Middle East, I'm sure the diesel prices will come back and the sulfur prices will come back.
Yeah, we've been saying that for a while now.
We have been, but this is only a recent conflict. Yeah. It hasn't been going on for years yet, and we'll see what happens. And these markets tend to find a way of kind of reconnecting, and we saw that with regards to Russia's invasion of Ukraine. Very, very huge price moves in the gas market short term, and then they started to soften back. But when we look at the market today and you look at the cost of production and you say, well, how has that changed over time? I started this job 32 years ago. The copper price was 60 cents a pound. It's now $6.50 a pound. Cost of production was, a few cents per pound. Now cost of production is $2 or $3 a pound and the price is $6. Fast forward 10 years from now, it's probably going to be $10 a pound and the cost of production will be $4 or $5. It's just it's the direction that everything's going. So I don't think it's anything new that we're seeing here.
So you can pass it on.
Yeah, and I think we will have greater visibility on cost impact in the second half, because in the first half, a lot of the companies were carrying inventory that they bought. So they would have pre-bought diesel, pre-bought sulfur, and so on. So we'll see more of that clarity in the second half of the year.
That detail will be interesting, won't it, in the second half, in terms of the cost. Evie Hambro, always a pleasure. Global Head of Thematic and Sector Investing at BlackRock. Thank you. Coming up, oil, meanwhile, continuing to push higher as the US and Iran, of course, lock into what looks like a stalemate at this point. More on that story coming up. This is Bloomberg. Welcome back. Oil rising for a fourth day as the US and Iran show no signs of progress towards a peace deal after almost 6 months of conflict. The stalemate leaving the Strait of Hormuz in doubt, with little traffic transiting the waterway and pressuring global energy markets. Let's get more with Bloomberg's Abir Abu Omar standing by for us in Dubai with the latest. No signs of talks then. Two sides seem to be digging in. And the UAE, meanwhile, is cutting most of its contact, it seems, with Iran.
Yeah, good morning, Tom. So this is, of course, after a ballistic missile threat alert that we all received here in Dubai yesterday, with the UAE Foreign Ministry later saying that it was targeted by 2 ballistic missiles from Iran. Iran denying those allegations, but then the UAE coming out and saying that it has cut all financial and trade ties with Iran. A senior advisor to the president, Anwar Gargash, a very important diplomatic figure here, saying that news of providing financial facilities hostilities to Iran are untrue. This is just moments ago. So threat in the region is escalating again one more time. This is the first type of such an attack that we saw in the UAE, at least for more than a month at this point. Of course, other countries in the region had been attacked over the past couple of months or so. Meanwhile, of course, traffic in the Strait of Hormuz, the prospects of that returning to anything that resembles normalcy is nowhere near. We reported this morning that 2 Chinese-flagged tankers had made U-turns, stopping in the Strait of Hormuz. So the risk of Iran or the U.S. military really hitting vessels that are trying to make their way through the Strait of Hormuz is still very much there. That deal between Iran and Oman is nowhere in sight. We still don't have a formalized draft. But Tom, perhaps what is the most interesting is a report that came out from the Financial Times earlier today saying that Iran, this is citing, of course, 2 people close to the regime, saying that Iran might be considering hitting Europe if the U.S. decides to escalate this war front again, citing Cyprus and a British airbase that had been targeted before by an Iranian drone, citing that as a possibility. So could we see the parameters of this war widening even beyond the Middle East and what we've reported in the Red Sea? The Yemen-based Houthis, of course, are active there against Saudi Arabia, Saudi vessels, and Saudi energy infrastructure. That is a real threat now, and the threat of this war widening is, of course, sending Brent crude prices rallying for a 4th straight day. It's settling nicely above that $90 per barrel mark. And so signs of danger all across the Middle East and potentially beyond.
Okay, Bloomberg's Abir Abu Omar, thank you for that update. Let's look ahead to what else we're watching throughout the day then. The AI Summit gets underway in Seoul. The ECB's Christine Lagarde has been speaking at the World Economic Forum's International Business Council. That will continue throughout the day. On the earnings front, stateside, Estee Lauder, Lowe's and Target. And at 7 p.m. UK time, we get the Fed minutes, of course, for the previous month. And it is reported that President Trump will be hosting an event with technology leaders, meanwhile, at 7:30 p.m. UK time.
OK, let's figure out what we do with these markets. We're mid-August. Let's just kind of always remember that and try and figure out, therefore, what we can really learn. Adam Linton from our MLIV team joining us around the table to wrap things up. Is that a factor that we need to think about? At the moment, this market seems to be very choppy. Tech up, tech down. Yields are up, today we're stable. There seems to be kind of big moves, but actually when you start to examine them and what's kind of backing them in terms of the volume that goes with them, maybe a little less.
Yeah, I think that's important. When you look at European equities, yes, we've had a little bit of a run of some down days, but ultimately we're still in close proximity to record highs. Volumes are thin and volatility is relatively low. I mean, what we saw kind of yesterday is, yes, we saw a bit of tech angles creep into Europe, but we know it has a lower gearing. But for Europe, again, what the issue is what we're seeing in developments in the energy market. So we've seen rising Brent crude prices, we've seen rising prices further down the barrel, and on a weighted basis yesterday, we saw some underperformance in industrials, and then also dynamics in the yield curve. We saw losses in financials, which has been a real key driver of the moves that we have seen throughout the year. So in that context, it is harder for Europe to act as a diversifier if there is some tech angst. But ultimately, the story for Europe has been one of resilience this year. Q2 earnings were solid. Expectations for Q3 and Q4 relatively upbeat. We've seen upgrades from Barclays this morning. So yes, there are reasons for caution, but alarm bells not ringing yet.
How does the bond view fit within that outlook in terms of yields have stabilized more today, a little bit of upside on bonds? Can that continue?
I think, for European, bond yields, I think, we are seeing some stabilisation, but I think it's hard to be too constructive in European paper at the moment. I think when you consider the drivers whereby we've kind of rolled from these crises after crisis, where it's COVID, it's been Ukraine, Russia, it's now US, Iran, without kind of a geopolitical off-ramp, we'll see increased borrowing costs, and that constrains European governments. And we've seen real acute strains in the French debt markets now, where they really kind of embody this trade-off that a lot of European governments are dealing with, whereby if they don't get their deficit down, they're going to risk the bond market. If they take tough spending decisions, that's a problem for the electorate. And we know we've got this French election looming next year. And does that sow the seeds of populism? The national rally are leading in the polls. And we're seeing a real markets widening in French and German spreads now. And we're kind of approaching those levels we saw in, I think it was June 2024, where we saw that snap election. And from a cross-asset perspective at the time, that was also a Euro story.
Gilts are getting a bid today. Is that on the inflation story, or is that the broader reset that we're seeing in bonds, at least for today globally? Is that a function of that element, or is it more inflation and traders kind of repricing around the BOE?
I think it's a combination of the two. I mean, the UK CPI data, that was in line. The rise that was widely telegraphed, and I think that's been kind of read as Bank of England have enough to be able to sit on their hands. The odds of a September move are particularly unlikely. I think what's more interesting for the gilt market is going forward. If energy prices stay elevated, there's clearly a tension between what the market's looking for and what the Bank of England is. Bank of England's much more concerned about the inflation growth trade-off relative to the likes of the ECB. We saw a study last week from the UK Treasury that was leaked to us suggesting that if the crisis drags on until the end of the year, UK growth could be zero next year. So I think the Bank of England are attentive to this, whereas market pricing is more concerned with inflation angst. So if the Bank of England are seen to be caught behind the curve, then we could see potentially a bit of a steepening in the UK yield curve. And as we know from previous episodes, that also could be relevant for the pound.
Thank you very much indeed. Nice update. Adam Linton joining us from our Markets Live team. What have we got coming up? Ed Yardeni is going to be joining the team a little bit later on, Chief Investment Strategist at Yardeni Research, joining the surveillance team at 12 p.m. London time. Earlier on this week, I think there was a well-read story on the Bloomberg Terminal talking about the fact that he's not hitting the panic button when it comes to yields just yet. So we're going to be exploring kind of when he would hit that panic button. We'll do that later. That's it for the opening trade. This is Bloomberg.